Google is preparing to issue a 100-year bond, a move that has stunned investors and highlighted just how distorted global financial markets have become. A century-long bond effectively asks investors to lock up capital for 4 generations, betting not only on Google's continued dominance, but on the stability of economic, technological, and political systems far beyond any reasonable forecasting horizon. The fact that such an instrument can attract demand says less about confidence and more about desperation for yield. This is not a rational allocation of capital. It is a symptom. In normal markets, long-term bonds compensate investors for inflation risk, regime changes, technological disruption, and uncertainty. In today's market, those risks are being priced as irrelevant. Investors are accepting ultra-long duration exposure at yields that offer little margin for error, all because safer alternatives have been suppressed or crowded. A 100-year bond magnifies every risk: inflation over decades, technological disruption, regulatory shifts, political and currency instability. No company, not even one as dominant as Google, can reasonably be assessed over that time frame. Entire industries rise and fall in less than 100 years. Yet markets are willing to pretend permanence exists. This is how excess reveals itself. When capital becomes cheap and abundant, discipline disappears. Issuers extend duration to absurd lengths. Buyers convince themselves that this time is different. It rarely is. Google issuing a 100-year bond is not a sign of strength. It is a sign of financial excess, a market so hungry for perceived safety and yield that it's willing to suspend common sense. When markets normalize, instruments like this are often remembered not as smart innovation, but as markers of the cycle's peak.